Hello, this is Warm Insight. Today, we're going to talk about the silent shifts in our economy and energy landscape. Leaving a like and subscribing is a huge help to us. What if I told you that the most dangerous economic threats do not come with a loud crash, a plummeting stock market, or screaming headlines, but instead arrive so quietly that you barely even notice your wealth evaporating? We have been conditioned by the media and by recent history to expect financial disasters to look like spectacular explosions. We expect the sudden collapse of a major investment bank, a global pandemic that shuts down the world in a single weekend, or a massive housing bubble bursting in spectacular fashion. But as we settle into the rhythm of a new week, the economic signals flashing across the dashboards of global markets are painting a much more nuanced and, frankly, a much more insidious picture for our financial and energy landscape. We are currently witnessing a persistent, grinding slowdown in global manufacturing. This is not a sudden drop. This is a slow, agonizing deceleration that is now stretched for 15 agonizing months. And to make matters worse, this industrial decay is now being coupled with a recent and very alarming dip in the services sector, a sector that had been the absolute, steadfast pillar of economic growth for the last 3 years. Overlaying this entire fragile situation is a very clear, uncompromising message from our central bank. They have established a firm commitment to higher interest rates, a policy that continues to fundamentally reshape the cost of doing business, the cost of living, and the cost of investing across every single sector of our economy. Let us start by looking under the hood of the American industrial machine. We need to talk about the persistent whisper of economic slowdown and what 15 months of manufacturing contraction actually means for your portfolio and our energy future. The latest reading on our nation's industrial pulse, which is measured by the Institute for Supply Management Manufacturing Index, came in at 49.1 for the month of May. Now, if you are not familiar with this index, a reading above 50 represents economic expansion, and a reading below 50 represents economic contraction. This recent reading of 49.1 marks an unbroken 15-month streak below that critical 50-point expansion threshold. This is not just a statistical anomaly. This is not a short-term glitch in the matrix. This is a quiet, sustained hum of deceleration, echoing through the very engine rooms of our economy. Think about what this actually looks like in the real world. It means factory managers are ordering fewer raw materials. It means assembly lines are running for fewer hours. It means the massive diesel trucks and freight trains that move finished goods across the continent are sitting idle in rail yards and parking lots just a little bit longer every single week. What is new and incredibly notable today is that this is no longer a blip or a short-term inventory correction. It has become a deeply entrenched, undeniable macroeconomic trend. Energy demand is the invisible shadow of economic production. When factories slow down, the massive industrial turbines that require gigawatts of electricity begin to spin just a little bit slower. The industrial consumption of natural gas, crude oil, and electricity always perfectly mirrors broader economic activity. When manufacturing shrinks, the baseline demand for energy inevitably shrinks alongside it. But the plot thickens and the danger grows because the contagion is spreading. For a long time, economists pointed to the services sector as our saving grace. They argued that the modern economy is driven by everyday consumers, going to restaurants, buying airline tickets, staying in hotels, and paying for digital subscriptions. As long as the services sector remained strong, the manufacturing recession did not matter. But that narrative is now crumbling. The Non-Manufacturing Purchasing Managers Index, which tracks the services sector, saw a fresh and unexpected dip in May, falling to 50.3. This is a very noticeable retreat from the previous month, which sat at 51.9. We are now dangerously close to that critical 50-point line. This tells us that the cooling trend is no longer confined to the factory floor. It is beginning to touch broader, much more sensitive parts of the economy. The American consumer, who has been relying on depleted pandemic savings and maxed out credit cards to sustain their lifestyle, is finally beginning to tap out. The contagion is moving from the industrial parks straight into the dining rooms and living rooms of everyday citizens. Meanwhile, the architects of our monetary system are watching this happen, and they are refusing to throw us a lifeline. A number of central bank officials at the Federal Reserve have recently stepped up to the microphone to reinforce their absolute commitment to maintaining higher interest rates. Earlier this year, Wall Street speculators were practically hallucinating, betting that the Federal Reserve would deliver 6 aggressive rate cuts to stimulate the economy. Then that expectation dropped to 3 cuts. Now, some seasoned market watchers are suggesting we might only see 1 rate cut this year, or perhaps none at all. The Federal Reserve is trapped in a war against sticky inflation, and they are willing to sacrifice economic growth to win that war. But we need to understand what a higher interest rate actually does to the physical world, especially in the capital-intensive world of energy. Energy is a game of massive, upfront capital expenditure. If a company wants to build a sprawling solar farm in the desert, or upgrade a critical natural gas pipeline across 3 states, or construct a state-of-the-art offshore drilling platform, they do not just use the cash they have on hand. They have to borrow hundreds of millions, sometimes billions of dollars. When interest rates were near zero, money was virtually free, and companies could afford to build almost anything. But today, with the cost of capital remaining elevated for longer, the mathematical equations that drive these projects have completely broken down. The debt payments are too high. The return on investment is too low. Therefore, the solar farm gets delayed. The pipeline upgrade is canceled. The drilling project is abandoned. This ongoing commitment to higher rates by our central bank simply means the cost of capital for new energy projects will remain punishingly high, encouraging extreme prudence over rapid expansion. This creates a massive, hidden bottleneck for our future energy supply.
To truly understand why investors are struggling to navigate this environment, we have to look at behavioral psychology. Our human minds are ancient instruments. We evolved to react to sudden dramatic threats. If a predator jumps out of the bushes, our adrenaline spikes, and we take immediate, decisive action to survive. We apply this exact same biological hardwiring to financial markets. We crave dramatic events. We understand a sharp market crash. We understand a sudden economic boom. When the stock market drops 2,000 points in a single day, investors panic, they sell their vulnerable assets, they hoard cash, and they restructure their portfolios. But what we are witnessing right now is completely different. We are experiencing a slow bleed scenario. It is a gradual, agonizing deceleration that is incredibly difficult for the human brain to process. It is the classic boiling frog syndrome. The temperature of the water goes up just 1 degree at a time, and the frog never realizes it is boiling until it is too late. The factory orders drop by 0.5%. The services sector dips by a single point. The interest rates stay flat for another month. Because there is no loud alarm bell, there is no decisive action taken by investors. Instead, this slow bleed leads to a lingering, exhausting unease. It is like watching a mighty river slowly dry up. You notice the water level dropping. You see the rocks exposing themselves on the riverbed. But the impact unfolds so slowly that you convince yourself the rain will come tomorrow. This psychological paralysis is the greatest danger to your wealth today. You watch your portfolio slowly bleed out, and because there was no spectacular crash, you never take defensive action. Historically speaking, these periods of sustained, slow industrial contraction are not unprecedented, and they offer us a very clear roadmap if we are willing to pay attention. Let us think back to the late 1990s during the buildup of the massive dot-com tech boom. Everyone was mesmerized by internet stocks and paper wealth. But underneath the surface, the industrial economy was quietly contracting. Energy demand was shifting. When the bubble finally popped, the underlying weakness of the real economy made the crash much more devastating. Or we can look at the years leading up to the 2008 housing downturn. People remember the dramatic bankruptcy of Lehman Brothers in the fall of 2008, but they forget that the housing market actually started cracking in 2006. The manufacturing sector started showing deep signs of stress long before the banks collapsed. It was a slow bleed that eventually triggered a sudden financial cardiac arrest. The philosophical takeaway here is one of absolute resilience and adaptation. We must learn from these historical precedents. The energy system does not simply collapse during these periods. It reshapes itself. It reallocates capital. The companies that planned for these difficult economic cycles, the companies that maintained fortified balance sheets, and refused to take on toxic debt when money was cheap, are the ones that tend to weather these periods and emerge dominant. This current extended period of manufacturing contraction, now confirmed by a fresh dip in services, serves as a powerful, unavoidable reminder that our economic foundations are subtly but surely shifting beneath our feet. This is not a prediction of absolute doom, but rather a clear, flashing signal to understand the underlying currents and how they steer the vast energy tanker of our global economy slowly but surely. So how do we protect ourselves? How do we invest when the paper economy is slowly bleeding and the cost of money is painfully high? We have to separate the real economy from the paper economy. The paper economy is made up of digital code, complex derivatives, and speculative growth stocks that require endless streams of cheap money to survive. The real economy is made of steel, concrete, barrels of oil, and flowing electrons. When the financial system is under stress, capital always flees the illusions of the paper economy and runs back to the physical reality of hard assets. For your asset allocation, you must consider energy infrastructure. I am talking about companies that own pipelines, massive storage terminals, and critical transmission lines. These assets offer a unique and powerful degree of resilience during broader economic slowdowns. Why? Because they operate under a completely different set of rules. Their underlying value is not purely tied to immediate demand, spikes, or the daily whims of consumer spending. Their value is tied to the essential non-negotiable needs of modern society. A pipeline company often operates on what is called a take-or-pay contract. That means the energy producer pays the pipeline company a fixed fee to reserve space in the pipe, regardless of whether they actually send a single drop of oil through it. It operates exactly like a toll booth on a vital highway. Whether the economy is booming or whether we are in a deep recession, people still need to turn on their lights. Hospitals still need to run their generators. The world still requires a baseline of power just to exist. These infrastructure companies generate stable, regulated, highly predictable cash flows. When you own these assets, you are anchoring your portfolio to the bedrock of civilization itself. You are insulating your wealth from the noise of the Federal Reserve and the panic of the daily headlines. I want to share a story with you that deeply shaped my understanding of exactly this concept. I remember a very tense time back in the fall of 1998. The Asian financial crisis was ripping through global markets. A massive hedge fund had just collapsed, threatening the entire banking system. Currency devaluations were making front-page news every single day. Everyone on Wall Street thought the sky was absolutely falling. The panic was palpable. I was young, incredibly anxious, and convinced that my financial future was ruined. I went to seek advice from my old mentor. He was a seasoned, tough-as-nails drilling rig operator down in Texas. He had survived the brutal oil embargoes of the 1970s and the devastating crude oil bust of the 1980s. I walked into his office sweating, talking a million miles a minute about central bank interventions and economic contagion. He just sat there, listening quietly, drinking a cup of black coffee. When I finally ran out of breath, he looked at me, gave a small wink, and said, "Son, the world still needs to turn, and people still need to get around. Find what makes the world turn." It was such a simple truth, yet it cut through all the complex financial jargon and mathematical models. It brought everything back down to the fundamental, physical reality of human existence. The world still needs to turn. The fundamentals of energy remain completely unchanged, regardless of what the inflation rate is doing or what the Federal Reserve decides to do next month. In times like these, when economic indicators are sending profoundly mixed signals and market sentiment shifts from day to day, it is incredibly easy for anxiety to creep into your decision-making process. But remember this, financial peace of mind does not come from refreshing your portfolio balance every hour. It comes from understanding the long game, not just the daily headlines. It comes from extending your time, horizon past the next quarter and looking toward the next decade. Take a moment today to review your energy holdings and your overall portfolio. Through this specific lens of enduring necessity and long-term utility, are you holding fragile assets that will shatter if the economy continues to slow down? Or do you own robust, cash-flowing assets that provide the foundational architecture for the modern world? You must stay diversified. You must stay informed by looking past the daily noise and focusing on the physical realities of supply and demand. And above all, you must trust the power of a well-considered, unemotional strategy. The winter of this economic cycle is slowly creeping in, but winter is necessary. It destroys the inefficient businesses, but it forces the strong ones to drive their roots deeper into the earth, preparing for the eventual spring. Now I want to hear directly from you. Take a hard look at your own investment strategy right now. Are you heavily invested in companies that rely on a roaring, debt-fueled economy to survive? Or have you started moving your capital into the essential, non-negotiable infrastructure that makes the world turn? Even in the darkest of times? Let me know your thoughts in the comments below.